While the retail crowd is obsessing over short-term price action, a massive divergence has appeared on the yearly time frame that nobody is talking about. Most investors are operating under the assumption that the traditional four-year cycle will repeat exactly as it has in the past. They believe that we will see a parabolic peak in late 2025, followed by a catastrophic crash in 2026. However, the on-chain data regarding long-term holder accumulation suggests that we are entering uncharted territory. If you are blindly following the historical playbook without accounting for the structural changes in market liquidity, you are positioning yourself to be the exit liquidity for Wall Street. The reality is that the 2026 market cycle is shaping up to be the ultimate test of conviction for every single asset holder. In the next few minutes, I am going to break down the mathematical case for why this cycle might break the historical mold. I will show you the specific data points regarding exchange reserves and realized cap that indicate a potential supercycle. We will also look at the counterargument and the precise signals that would confirm a bull trap is forming. Let us get into the weeds. The first thing we need to address is the concept of the four-year cycle and why it is currently under threat. Historically, Bitcoin has followed a very predictable pattern based on the halving schedule. We see a supply shock, followed by a mania phase, and then a brutal distribution year where prices retrace 80% or more. This is the model that 90% of market participants are using to plan their exits. However, the introduction of the spot exchange-traded funds has fundamentally altered the demand side of this equation. For the first time in history, we have a persistent passive bid from institutional capital that does not care about retail sentiment. When we look at the 30-day moving average of inflows into these investment vehicles, we see a floor of support that did not exist in 2020 or 2017. This matters because it dampens the volatility that is required to create a blow-off top and a subsequent 80% crash. The data shows that the realized volatility of Bitcoin is trending down on a multi-year time frame. If volatility decreases, the likelihood of a parabolic spike to unsustainable levels also decreases. Instead of a sharp peak in 2025 and a crash in 2026, we might be looking at a prolonged period of appreciation. This is what analysts refer to as the supercycle theory. A supercycle occurs when an asset matures and transitions from a speculative risk asset to a global store of value. In this scenario, 2026 does not bring a bear market, but rather a year of consolidation and steady growth. However, we must remain objective and look at the risks involved in this thesis. The danger of believing in a supercycle is that it creates complacency. If you convince yourself that the price will only go up, you will fail to take profits when the market becomes overextended. We are seeing a concerning metric regarding the short-term holder cost basis. Currently, the gap between the long-term holder realized price and the current market price is widening at an alarming rate. Historically, when this ratio stretches too far, the market snaps back violently to flush out leverage. The reality is that market makers are aware that everyone expects the cycle to extend. This is where the concept of the bull trap comes into play. If the market consensus shifts unanimously toward a supercycle, the path of maximum pain shifts to the downside. We could see a scenario where 2026 begins with a false breakout that lures in the last wave of retail capital. This would be followed by a sharp correction that mimics a bear market start, shaking out the weak hands who thought they were safe. Here's why this matters for your portfolio strategy. You cannot afford to be dogmatic about either outcome. You need to be watching the M2 money supply and global liquidity injections from central banks. The correlation between Bitcoin price action and global liquidity is tighter than any other metric. If central banks begin to tighten rates or reduce their balance sheets in 2026, the supercycle thesis will collapse immediately. If this level of detailed analysis is helping you stay ahead of the crowd, feel free to join our inner circle by subscribing for more updates. Let us dig deeper into the supply dynamics on the exchanges. The total balance of Bitcoin across all major exchanges has hit a 5-year low. This is a supply shock that is happening in slow motion. In previous cycles, we saw exchange balances increase as price went up, indicating that whales were moving coins to sell. Right now, we are seeing the opposite trend. As the price appreciates, coins are continuing to leave exchanges and moving into cold storage and custodian wallets. This behavior suggests that the smartest money in the room is not planning to sell in 2025. They are positioning for a time frame that extends well into the late 2020s. This creates a scenario where the sell-side liquidity crisis could drive prices higher than anyone anticipates. However, there is a caveat to this bullish data. We must consider the potential for regulatory headwinds that could trigger a forced selling event. If regulators decide to crack down on custody rules or tax unrealized gains, we could see a flood of supply hit the market, regardless of the cycle timing. This is why relying solely on on-chain data can be dangerous if you ignore the geopolitical landscape. Another critical factor is the behavior of the Ethereum and altcoin markets relative to Bitcoin. In a traditional cycle, profits rotate from Bitcoin into Ethereum and then into higher risk assets. Currently, the dominance of Bitcoin remains stubbornly high. This lack of capital rotation suggests that we are still in the early to middle stages of the macro trend. If we enter 2026 and Bitcoin dominance has not broken down significantly, it strengthens the supercycle argument. It would mean that the market is refusing to take on excessive risk, preferring the safety of the pristine asset. On the other hand, if we see a massive altcoin mania in late 2025, it is a leading indicator of a market top. That would be the signal that the 2026 bear market is imminent. The psychological component of this market cannot be overstated. Investors are currently battling the trauma of the 2022 collapse. This trauma makes them likely to sell too early, anticipating a crash that might not come. Institutions know this, and they will likely drive the price through those psychological resistance levels to force investors to chase the market higher. This chase is what forms the final trap. If you find yourself buying back in at higher prices in early 2026 because you sold too early, you are walking into the trap. The smart play is to establish your position now and sit on your hands. The reality is that the market is designed to transfer wealth from the impatient to the patient. We are also seeing a divergence in the derivatives market. Open interest in futures contracts is reaching all-time highs, but funding rates remain relatively neutral. This indicates that the leverage in the system is not yet at a euphoric level. Euphoria is the prerequisite for a cycle-ending crash. Until we see funding rates skyrocket and retail traders taking out massive loans to buy, the top is likely not in. This lends credibility to the idea that the cycle will extend further than most expect. However, you must be vigilant about the macroeconomic data coming out of the United States. The debt refinancing cycle for the U.S. government hits a critical point in 2026. This could force the Federal Reserve to print money to monetize the debt, which would be bullish for hard assets. But if they choose to defend the currency instead, it would be catastrophic for risk assets. This binary outcome is what makes the 2026 forecast so difficult. It is not just about crypto market cycles anymore. It is about the global sovereign debt cycle. If you want to navigate these complex macro waters with us, make sure you are notified of our future breakdowns. Now, let us look at the miner capitulation metrics. Miners have been under immense pressure since the halving, and many have been forced to modernize their fleets. Usually a cycle bottom is marked by miner capitulation, and a top is marked by miner profitability reaching obscene levels. We are currently in a healthy middle ground, where miners are profitable, but not printing excessive cash. This suggests the network is in a sustainable growth phase. If we project this trend forward, 2026 looks less like a crash and more like a maturation phase. So, is it a supercycle or a bull trap? The answer lies in the liquidity. If global liquidity remains expansive, the supercycle is the most probable outcome. If liquidity contracts, the bull trap will snap shut on everyone expecting a forever pump. Here's the playbook you need to follow to survive either scenario. Do not use leverage in the year 2026. If the supercycle plays out, spot positions will generate generational wealth without the risk of liquidation. If the bull trap plays out, leverage will wipe you out before you have a chance to react. You must set clear invalidation points for your thesis. If Bitcoin drops below the 200-week moving average and stays there, the supercycle thesis is invalid. At that point, you must switch to capital preservation mode. Do not marry a narrative. The market does not care what you believe. It only cares about order flow. The evidence right now favors an extended cycle due to the institutional floor. But that floor can turn into a ceiling if the macro environment shifts. Keep your eyes on the exchange inflows, the realized cap, and the Federal Reserve policy. Those three metrics will tell you everything you need to know. We are standing at the precipice of the most complex financial era in history. The 2026 cycle will define who understands the new paradigm and who is stuck in the past. Stay sharp, stay skeptical, and trust the data over the hype. Nothing in this video constitutes financial advice. Investing in digital assets involves significant risk, and you should always conduct your own due diligence before making any financial decisions. The market is ruthless, and only the prepared will survive.